Okay, is this on? Yes. Hello, everyone. My name is Chris Phelan. I'm the interim director of the Heller-Hurwicz Economics Institute. And in that capacity, it is my pleasure to welcome you here today. The mission of the Heller-Hurwicz Economics Institute is to build a bridge between the leading edge economic research that happens here on campus and the business leaders, policymakers, community members, government officials, and the broader public who can benefit from that research. We fulfill this mission through events like this, as well as other public-focused communications, including our Office Hours podcast. You can get it from all the ways you get podcasts. And also investing in rigorous research done by the top University of Minnesota economists and students, all with the goal of influencing real-world economic policy decisions that promote the public good. We are excited to welcome you to this event, which promises to be a very engaging conversation. We're joined by economists, policymakers, journalists, students, faculty, and others interested in understanding economic issues. I would like to extend a special welcome to members of the Heller-Hurwicz Economics Institute board who are here tonight and provide critical support to help us advance our mission. I would also like to welcome the Dean of the College of Liberal Arts, who I think will be here later, Gershon Avilez. Along with those of you in the room, we also have many guests tuning in virtually. Thank you all for being here. Our presentation tonight features Dr. Adriana Kugler, a member of the Federal Reserve Board of Governors and a native Minneapolitan. I usually take great pleasure in bragging about our distinguished PhD alums, but Governor Kugler is an alum of Berkeley, not here. But her father is a PhD alum of our program, which is why she's a native Minneapolitan. So I'm just going to take credit for her as well. Our moderator will be Dr. Juan Pablo Nicolini, a senior researcher economist at the Federal Reserve Bank of Minneapolis. Please join me in welcoming our speakers to the stage. And now over to Wampa.
Okay, thank you. Thank you very much for being here. It is a great pleasure and a great honor for me to be introducing to you Governor Kugler. I first met her in the late 90s. I'm much older than her because she was just coming with her Berkeley PhD. And I was working at the time at the Universitat Pompeu Fabra in Barcelona. And we saw her paper, we saw her CV, and we said, she's going to make it, so let's make her an offer. And we did, and she accepted. And boy, we were right, she made it. She got tenure there, of course, but then she came to the US, University of Houston. She's also been affiliated and still affiliated to the Georgetown University. But she also moved to do policy work. She's been a chief economist for the US Department of Labor, US Executive Director for the World Bank, and is currently governor at the board. She also got involved with university administration, so I guess you've done it all, and you still have a long way to go. Thank you. It's a great pleasure, again, to welcome Governor Kugler, Adriana, to talk to us today about monetary policy, inflation, and all the other things you want to know. Adriana,
thank you.
Pleasure.
Thank you. Well, thank you so much, Chris and Juan Pablo. I didn't get one introduction, but two introductions. Thank you very much. I am just so delighted to be here at the University of Minnesota because in many ways, and as you already know, this visit feels like a homecoming for me. I was born right here in Minneapolis before I moved to Columbia as a very young child. My parents told me so many wonderful stories about this area and the university. My father studied for his PhD here in the economics department, and he studied under accomplished economists, including Ann Kugler, Leo Horwitz, John Butler, and Ed Foster, who is still here today with us as an emeritus professor. The University of Minnesota has made many contributions to the field of economics, producing several Nobel Prizes, and has historically had a very close relationship with the Federal Reserve Bank of Minneapolis. So you really are a part of the Fed's extended family, and it is such an honor to speak with you. Today, I would like to speak with you about the transmission of the Fed's monetary policy. I will discuss how monetary policy is transmitted through the economy. Then I will touch on how I monitor its transmission. And lastly, I will talk about two elements related to transmission that I evaluate when making monetary policy decisions. Those elements are the long and variable lags of monetary policy that many of you have heard about, and whether its transmission is asymmetric and has actually changed over time. But before I delve into my primary topic, I would like to start by offering my own views on the economic outlook. The US economy has grown at a solid pace, with real gross domestic product, or GDP, expanding at 2.5% last year. Activity indicators in the first few months of this year show healthy numbers. Last week, the release of March retail sales showed resilient consumption with positive revisions for January and February. However, measures of household sentiment, such as surveys from the University of Michigan, the Conference Board, and the Morning Consult, have shown quite a bit of softness. Many survey respondents report that their views reflect trade policy concerns, though as we have seen, the exact contours of those policies are still taking shape. Thus, GDP growth for the first quarter, which will be reported next week, may show some moderation relative to what we saw in 24. Though this moderation may be offset somewhat by the front-loading ahead of the implementation of tariffs. Financial markets have experienced increased volatility in recent weeks, and if financial conditions were to tighten persistently, that could weigh on growth in the future. The labor market remains solid, but the pace of hiring has certainly eased this year. In the first quarter, US employers added 152,000 jobs per month on average, compared with a monthly pace of 168,000 on average last year. The unemployment rate edged up last month to 4.2%, but it is still low by historical standards, and it has been at this level since about last summer. Moreover, initial jobless claims have remained stable at low levels. Those numbers are consistent with other measures indicating that the labor market is roughly in balance. With respect to inflation, progress has slowed since last summer, and inflation remains still above our 2% target. Based on the Consumer Price Index, or CPI, as well as the Producer Price Index, or PPI, the 12-month change in the Personal Consumption, or PCE, Price Index, which will also be released next week, is estimated to have been at 2.3% last month and 2.6% for the core categories, which excludes food and energy. I pay careful attention as well to two subcategories of inflation. The first one is core goods, which are goods outside of these volatile food and energy products. And the second is non-housing market-based services, which are based on transactions and not imputed prices, and includes things such as car maintenance, and haircuts. Goods inflation was negative for most of 24, as was the norm for several years before the pandemic. But it increased to a positive 0.4% in January and February. In March, the CPI and PPI releases pointed to goods inflation, decreasing to a still positive 0.1%, which is somewhat better. But I care about this measure because this measure has helped us to keep a lead on total inflation. By contrast, non-housing market services inflation, which accounts for about 50% of the PCE, that's why I care about it so much, is a big component within our index of inflation, it stayed elevated through March at an estimated 3.4%. That category often provides a good signal of inflationary pressures across all services. As we look ahead, while the long-run level of tariffs is still to be determined, tariffs have moved significantly higher this year. That will likely put upward pressure on prices. For instance, both survey and market-based measures of near-term inflation expectations have moved up. Longer-term inflation expectations largely remain well anchored and consistent with our 2% inflation goal, and I hope they will continue to stay that way. I am closely monitoring incoming data and the cumulative effects of both sides of our mandate from policies in 4 distinct areas, not only trade, but also immigration, fiscal policy, and regulation. I am also monitoring any risks to the outlook, especially upside risks on inflation or downside risks to employment. Still, I think our monetary policy is well positioned for changes in the macroeconomic environment. Thus, I will support maintaining the current policy rate for as long as these upside risks to inflation continue, while economic activity and employment remain stable. Of course, I remain fully committed to achieving both of our dual mandate goals of maximum employment and stable prices. Now, turning to the primary topic of my speech, I will first discuss how monetary policy is transmitted through the economy. And in this section, I will give some examples from the recent past as a tool for explaining my arguments, but I am not intending to comment further on the latest developments in the economy. Understanding the transmission of monetary policy starts with understanding how the Federal Reserve uses its policy tools. The Federal Open Market Committee, or FOMC, adjusts the target range for the federal funds rate, or the rate at which banks lend to each other for overnight borrowing. Setting the federal funds rate is the primary means by which the Fed adjusts the stance of monetary policy among its range of tools that we have to set monetary policy. In addition to the FOMC directly adjusting the federal funds rate, Fed policymakers' communications about the future path of monetary policy may also result in changes to longer-term interest rates because both households and businesses' expectations about future policy affect the level of interest rates. Adjustments to the federal funds rate affect a multitude of financial conditions faced by consumers and businesses. For example, changes to the federal funds rate filter through to interest rates lenders charge for loans to businesses and households, as well as to what financial institutions pay in interest on deposits. The current and expected future path of the federal funds rate also affects asset prices as it changes the relative attractiveness of different investments, such as stocks and real estate. Fluctuations in both interest rates and asset prices affect, in turn, households' wealth and a corporation's balance sheet, which can, in turn, affect the terms under which they can borrow. I have discussed some of the most common ways in which policy is transmitted, but there are others. For example, exchange rates and international spillovers that I will not discuss today. In fact, research suggests that the channels of transmission are extensive and ever-evolving. Consumers and businesses make decisions based on financial conditions. For illustrative purposes, let's consider a period when the FOMC views it as appropriate to ease the restrictiveness of monetary policy by reducing the target range from the federal funds rate over time. The resulting lower interest rates on consumer loans elicit greater spending of goods and services, particularly on durable goods that are often financed by households. Lower mortgage rates can encourage renters to buy a home by reducing the monthly payments borrowers face, and can also encourage existing homeowners to refinance their mortgages to free up cash for other purchases. Lower interest rates can make holding equities more attractive, which raises stock prices and adds to wealth. And higher wealth tends to spur more spending, as households tend to consume at least a portion of their increased wealth. Investment projects that businesses previously believed would be marginally unprofitable become attractive because of reduced financing costs, particularly if businesses expect sales to go up. Expecting a better macroeconomic environment and lower delinquency rates down the road, banks may also loosen their lending standards on approving loans for households and businesses. So all these decisions support aggregate demand and may put upward pressure on inflation. Of course, there are periods when policymakers see it as appropriate to increase the level of restraint placed on the economy by raising the federal funds rate over time. That may occur when policymakers are seeking to lower inflation. Then the monetary policy effects I just described would actually reverse, putting downward pressure on aggregate demand and on inflation as well. Let me now discuss how I view the transmission and the stance of monetary policy during the past few quarters. To be clear, I will not discuss the developments in financial markets over the past few weeks. In the second half of last year, I gained greater confidence that inflation was on a sustainable path towards the FOMC's 2% objective. I also wanted to preserve the strength I saw in the labor market. As a result, I supported the FOMC's decision to decrease the target range for the federal funds rate by a total of 1 percentage point during the meetings from September through December. However, even before the committee began to ease policy, some financial conditions started to ease. This easing can be seen in the Financial Conditions Impulse on Growth Index, or FCIG, and that index has been developed by Federal Reserve Board staff and has shown easier financial conditions from March of 2024. And through January, the demand for loans by households and businesses also picked up. In the early months of the year, financial conditions, however, remained somewhat restrictive as borrowing costs continued to be elevated and bank credit became moderately tight. For example, through March, interest rates on short-term small business loans had only edged down since their post-pandemic peak. Banks stopped tightening lending standards after 9 consecutive quarters, but they left the standards unchanged in January. These financial conditions help to moderate aggregate demand and aid in moving inflation sustainably towards our 2% target. Monitoring financial conditions, the ones I just described, is one important way that I use to evaluate how well the Fed's monetary policy is being transmitted to the rest of the economy. But it is not the only way. I also consider 2 other elements that play important roles in the transmission of monetary policy. The first element I evaluate is the timing with which monetary policy affects the macroeconomy. The contemporary economics literature uses a variety of statistical models to estimate the effects of what are called monetary policy shocks. Those are movements in the policy rate that are not explained by estimates of how monetary policy systematically responds to incoming economic and financial data, and are not anticipated by the public. Focusing on the estimated effects of these shocks helps isolate the consequences solidly coming from monetary policy actions and communication. One lesson that emerges from this research is that, broadly speaking, it turns out that Milton Friedman's long and variable lags concept still holds. A selection of key studies on the topic estimates that it takes about 1 to 2 years for the maximum effects of policy to be observed in economic activity and inflation. These long lags in monetary policy affecting the economy point to why it is so very important for policymakers to anticipate economic conditions as best as possible and to try to be proactive about understanding the effects of different shocks to the economy so they can act quickly when required. The second element I consider when making decisions related to monetary policy is whether its transmission has been equally impactful during different points in time. For example, there is credible evidence indicating that contractionary monetary policy shocks may generally decrease economic activity more than expansionary policy shocks increase it. To understand these asymmetries, consider the following illustrative metaphor used by Merrimer Eccles, who led the Fed all the way back in 1930. I imagine, according to Eccles, is what he said, imagine a string with monetary policy on one end and the economy on the other end. Employing tight monetary policy when inflation is rising is like pulling on that string to keep the economy in check. It works fairly well. But attempting to stimulate the economy with loose monetary policy during a downturn is like trying to push on a string to move the economy. That's not going to work too well. That's a more difficult task. So there is evidence of this asymmetry in consumer spending, in fact, on long-lasting durable goods. And it's research from the Federal Reserve Bank of Minneapolis. So what we see is that durable goods, such as vehicles and appliances, will initially respond to this loosening of monetary policy, but eventually that effect will die down. While an easier monetary policy may lower interest rates and thus stimulate spending on durable goods in the near term, the effects of that policy may be smaller over time, as households may already have purchased those durable goods. For example, if a family replaces their living room furniture when rates are low, they're unlikely to need a new set of furniture a few years later, and thus would not consider how current rates would change their decisions. Thus, during an easing cycle, it is reasonable to suspect that the potency of monetary policy may be somewhat diminished. Another example of asymmetry can be seen in the transmission of monetary policy to private lending. Board staff research documents a strong growth in the period between the global financial crisis and the pandemic, fueled by structural factors such as the attractiveness of the market to borrowers and investors due to its higher customization. One implication of this strong growth during this past policy tightening is that monetary policy transmission to private credit markets appears more muted relative to those that go through public credit markets or bank commercial and industrial lending. By contrast, other factors specific to the recent period likely decrease the potency of monetary policy during the tightening cycle, but may increase it during the easing cycle. When the pandemic struck and social distancing was common, many households severely curtailed spending. You all remember that. In addition, a historic level of government transfers boosted household income. This combination led to the personal savings rate soaring. Recent work by board staff suggests that these excess savings accumulated during the pandemic may have reduced the effect of tighter monetary policy over recent years. If households are flush with excess cash, they're less likely to respond to elevated interest rates by curtailing demand. Instead, they may have funds to avoid financing or may feel that they're able to afford higher monthly payments. Now, right now, with some 5 years after the pandemic, these excess savings are depleted. This creates an environment in which monetary policy could be back to having its average effects on the household sector. Although we should also consider that the financial health of borrowers with lower credit scores has deteriorated meaningfully in recent years. And as you know, credit card and auto loan delinquencies are now above pre-pandemic levels. For those households, easing monetary policy may actually have a larger effect now. I am closely monitoring all of these possible changes in monetary policy transmission across the economy. Also, I am humbly aware that it is difficult for economists to judge the overall effect of monetary policy actions on the US economy in real time. To summarize, I see inflation is still running above the 2% target, while the labor market has remained stable. But the economy is facing heightened uncertainty with upside risk to inflation and downside risk to employment. This month, we learned that the tariff increases are significantly larger than previously expected. As a result, the economic effects of tariffs and the associated uncertainty are also likely to be larger than we anticipated. It is important for monetary policymakers to broadly examine all available information, including market-based measures, surveys, and anecdotal reports as well, to understand what is happening in the economy as early as possible. Because as I discussed, it takes time for policy to have an impact. As the direction of the economy changes, it is critical to pay close attention to the real-time data and to consider the lags and asymmetries of policy transmission to ensure we respond not only to the actual movements on both sides of our mandate, but also to the risks to the economic outlook. As I observe the economy and consider the appropriate path of monetary policy, I am closely studying how the decisions that the FOMC makes are transmitted through the economy. We have learned much about how those transmission channels work and how they may have changed in recent years. And there is much more to learn indeed. I am quite confident that some of that research will come from right here, from the University of Minnesota. I have no doubt. Overall, of course, when setting policy, I am guided by how best to achieve the dual mandate goals of maximum employment and stable prices given to us by Congress, because the results are the best outcomes for all Americans that we can hope. Thank you again for such a warm welcome to the Twin Cities.
Okay, thank you very much. So I guess we're going to open the floor for questions. But Dr. Phelan wants to make an interruption.
To tell you what the format is going to be.
Okay.
So the format is going to be questions by section, 3 at a time. So we'll allow 3 questions to be asked, and then Governor Kugler will answer them.
Thank you.
Good. So while hands go up and the mic moves, I'm going to start them with one, which is to some extent we had a increase in inflation after the COVID shock that very few, if any, saw coming, and extreme measures had to be taken. So what would you say are the main lessons from that episode in general, and specifically whether the episode gave particular insights into the transmission mechanism, which is the subject of your lecture today?
Yeah, thank you.
Should we take 3? Or we'll start with this one and then we'll take
Okay.
the 3.
So is this working?
Yep.
Okay. So thank you for that question. So I think, it's interesting to contrast the most recent bout of inflation to what we lived through in the 1970s and early 1980s, I would say, because that's the closest to that level of inflation that we've seen in the past few decades. Although, as you know, the highest level of inflation this time around was 7.2%. Back in the 70s and 80s, it went above 11% in 74, and again above 10% in 1980. So in both cases, I would say we had these negative supply shocks. In that case, it was certainly driven by oil shocks. In this case, when we had the pandemic, the shocks came from supply side disruptions, supply snarls, right? And a lot of problems in transportation, in logistics, in getting things produced. So that continued for some time. But another similarity, I suppose, is that both back then and now, in the most recent bout of inflation, there was a lot of tightness in the labor market. So back in the 60s, late 60s, the V2U ratio, the vacancy to unemployment ratio, which we use to try to see how close, right, the number of vacancies is to the number of people available to work, and it tells you a little bit about how tight or loose the labor market is, had gone up in the late 1960s. So that in itself can cause inflationary pressures because wage growth goes up. As wage growth goes up, that can be passed on to consumers in those sectors that heavily rely on workers and labor, such as services. This time around, we had something similar. Not initially when the pandemic started, because people actually removed themselves from the labor force. They stayed at home. As you well remember, it was a tragic time for many of us. We all forget now, but it hasn't been that long, right? People stayed home because they had to take care of children, they had to take care of parents, they were worried about getting infected. Population growth went down drastically, many fewer immigrants working in the economy. So all of that created shortages. But in fact, eventually, the opposite happened. People went back into work, and there were many more workers. But those shortages, that tightness, created upward pressures on wage growth, and that wage growth created problems, especially for services sectors. So that was another commonality. What I would say was different, so a couple of things, important differences between the 70s and what we live through now, is that back then, obviously, inflation expectations were not well anchored. And that has served us very well this time around. In fact, you see inflation going up this time and coming down. And in fact, inflation expectations have stayed roughly constant, around 2-3%, pretty well anchored. That helps us a lot, because if people expect prices to go significantly up, that means you expect as a producer, for example, that your input costs, your materials, everything you buy to produce something is going to go up, and you pass it on to the consumer. Or as a worker, right? If you expect that your gas prices, your milk, your eggs, your milk, everything you buy is going to go up, the next time you go and ask for a job, you're going to ask for a higher wage. You negotiate for higher salaries. So that feeds back into the economy. So when you have inflation expectations which are unanchored, it can feed back into inflation. It can become a spiral. That's not what we saw this time around. And that has served us very, very well. Another difference is that I think this time around, we saw different waves of inflation. So initially, the rise in inflation came from food, from goods, because there was a rotation, from services. If you remember, we were all at home, unable to go out, to go to concerts, to go to the movies, to go to eat, right? So people turned to buying goods. And that meant that goods prices really spiked. And factories didn't have enough workers to go around, and people didn't want to go to the factories because they were afraid of getting infected, right? You remember those meat prices going up really high, and chicken prices, everything that needed to be produced right in factories. So that created that first spike in goods. Eventually, when the economy reopened, late 2021, everything turned back to services. And then services prices really spiked. That, combined with the fact that you had all these shortages of workers and a very tight labor market, meant that wage growth happened, which was good for workers. But by the same token, those employers and businesses started passing on some of those wage increases also to consumers. So it turned to then. And then the next one, the next wave came much later, was housing. Yeah. So you remember that. So it's been a little different this time around, because you've seen that inflation pass right from one category to another. And we've had to figure out what is driving. It's very different, the nature of what drives that inflation. In goods, which has been supply snarls. In the case of services, it's been highly related to shortages of workers and the very tight labor markets. And in the case of housing, it has to do with the nature of the contracts and the fact that, basically it's catch-up inflation. You're kind of passing on that increase in rents if you have a tenant only 1 year later, because most of these leases are 1 year long leases. So 1 year later, you eventually raise rents, and it shows up much later in terms of prices. So once we got a hold of goods inflation, we got a hold pretty much of services, it started going down. It was becoming very hard to bring down housing inflation, and now fortunately it's coming down. But all of that to say, we are now in a different situation, as you know, which is that we're facing other potential shocks. And as we all know, much of that is related to the tariffs that have been announced and the uncertainty behind those tariffs as well.
Here? Yeah, but there's a mic, so everybody.
Well, in conducting its,
Do you mind
Thank-
introducing yourself?
yeah, I'm Gary Stern.
Thank you.
In conducting its bank supervision policies, I know the Fed requires major commercial banks and central counterparties and other large institutions to look at extreme but plausible macroeconomic conditions and analyze what they mean for the bank's balance sheets, earnings, liquidity, et cetera. And I'm wondering if the Fed has done a similar exercise given looming tariffs, reductions in government programs, potential disruptions in the labor market. Given all that, has the Fed looked at extreme but plausible outcomes for the economy? And assuming you have, what have you learned from that exercise?
Any other? Up there? Oh.
I don't want to keep you from getting to Gary's question, and I'm afraid this might be one you don't think you should comment too much on. But you know, when we went through the problems in financial markets a week and a half, 2 weeks ago, and we had the sharp falls in equity markets, a typical phenomenon is that bond prices go, U.S. bond prices go up. You know, I mean, we have been the world's reserve currency. And, you know, as de Gaulle's Minister of Finance called the U.S.'s position, we have exorbitant privilege because of that. And maybe we're losing it, and that's because international financial markets don't see the U.S. so much as a safe haven. They lack confidence in U.S. policy. And the Governor Kugler, I don't want to look directly at you, but that means they're losing confidence in the Federal Reserve System. I just wonder if you want to comment on that.
Third question there. While you think on whether you want to comment on that.
Thanks for coming tonight, Mike. I work in mortgages. So a couple of quick questions. First, a lot of people thought the inflation was transitory, and everyone kind of backtracked. And then after the fact, it was either Stiglitz or Krugman came out and said it was transitory. I wonder if you have any thoughts if it really was transitory or not. Second is most of the last 5 years, wages were outpacing inflation on an annual basis. But on the aggregate as a whole, you know, they're still behind. The calendar year 22, wages were way behind the inflation. So we're still kind of playing catch up. Are the wages going to play a full catch up to the inflation over the aggregate? Is that anytime soon? And then I'm asking how things are in the office with the last couple of days with the White House trying to take out Powell, whatever way they can. Thanks.
So that was 3 questions, right there. By the way. That wasn't one. So I have now
For the
5
price of one.
questions, right? So to Gary's question, yes, and I said it in my speech. We certainly consider all sorts of different scenarios, believe me. I feel very fortunate that we have an incredible group of economists, both at the board, but also I count on the research and the work that gets done in the research banks. And I can definitely tell you, we consider many different scenarios. And I'm one of those, being who I am, a curious academic as well, or having that background, who asks many questions and make sure that we're trying to cover every potential possibility. And in fact, you know, that has served as well, because while the level of increases that we have seen in tariffs was not expected by many, that was, not too far from some of the scenarios that we had. And so we could understand what may be coming our way. So the answer is yes, we definitely are aware of the huge responsibility that we have. And so we want to try to understand many potential possibilities, especially with the levels of uncertainty that we're living through. So to Tim, I disagree. I don't think the public is losing confidence in us at all. I think, in fact, we have a lot of trust from the public. I mean, the fact that inflation expectations have stayed so well anchored is very telling, right? Of how much the public understands our reaction function. The public understands our commitment to the dual mandate. So I would not say that, yes, those correlations that we're seeing today, a fall in stock prices, right? Yields going down, and the dollar depreciating is very uncommon, right? We don't know if that's there to stay or not. It's true, it's different, right? From what we saw even during the global financial crisis. But I would not want to jump to conclusions and say that that's already showing that we may no longer be the safe haven that we used to be. I think it's too early to tell. I would not jump to that conclusion. And I would certainly not say that that reflects on our work. I would certainly not say that. The uncertainty is not coming from us. The uncertainty, the high levels of uncertainty we're living through are coming from other parts of the economy. So I would disagree with you. And I respect you greatly, but I have to tell you, I really disagree strongly with you on that. And Mike, you asked 3 questions. 2 of them I probably cannot answer, or I could, but obviously I have kind of talked about how the inflation episode that we just lived through, the bout of inflation, had different waves, right? First, it was food inflation. That was in 2020, in fact. Then at the end of 2020, you started to see goods inflation go up. And it went up and it came down. And it started coming down by 2022, and eventually it came down to negative territory the way it was pre-pandemic. But then you had services inflation. And that was driven by some different factors. And that it started going up, and it only started coming down much later in 2020, end of 22. And then you had, in fact, 2023, housing inflation peak. And that only started going down much more recently and much more slowly. So the answer is no, it was prolonged, right? Now, you're talking about wages and whether, they're going to continue to go up. No. In fact, wages have come down to under 4%, which is consistent with 2% inflation and productivity at 2.14, which is what it is now. So in fact, wages right now, as they are, I don't know what's going to happen moving forward, but I can tell you the way things are now, with the productivity levels that we have now, are consistent with 2% inflation and are not putting inflationary pressures on the services sector any longer. Now, what's going to happen in the future? We're going to see shortages again, right? Do we have less people to work in certain sectors, in construction, agriculture, in services sector? That may come, but it's not the situation today, and we had been moving in a very good trajectory. So I was definitely no longer concerned by the end of last year about that being a source of inflationary pressures any longer.
Questions here?
Thank you for being here. Appreciate it very much. Art Rolnick, and I've got a question about, there are a number of prominent economists, business people who said when the Fed is aiming to lower the inflation and bring it down to its target, there's going to be a major recession. And it may last for 2 years, 5 years, but I think that was the common wisdom. We didn't get a recession. The Fed, I think, did a very good job, and we brought inflation down without a recession. What's the lesson you take from that?
Hi, thank you. A lot of talk today about returning manufacturing to the United States. But I wonder, with the changes in manufacturing in the post-war era and the changes in the American consumer lifestyle, can the United States actually support en masse a manufacturing system that people would be able to pay for and that would really sustain labor?
I'm going to add the third one then.
Yeah.
Just because you mentioned something on the recent answer about, and I had not thought about it. So we've seen clear changes in policy regarding immigration. So and you explicitly mentioned that part of what happened during COVID was that migration went down, but then it was coming up. If these policies are successful and then the inflow of migrants goes down, that would change a little bit the way you would be, I guess, thinking on the evolution of the labor market, at least compared to what it was a couple of months ago. How do you see that moving forward in terms of the effect that would have on the supply of labor and eventually on employment?
Yeah, let me start with your question. So it is true, I think, and it relates to your question as well, because I think it's no secret, and I've given several speeches about this, I think there were two positive supply shocks that really helped us to bring down inflation without creating massive unemployment or creating a recession. And those two positive supply shocks, one of them was population growth, much of it fueled by immigration, but also prime age labor force participation. We saw historically high participations of women in the labor force in the prime age. Never seen before, ever. So those inflows that we saw of labor definitely helped to rebalance the labor market, take care of those shortages that we saw, and that helped to bring down prices on the one hand, right, to moderate wages, and then to bring down prices certainly in the services sector. The other shock that really helped was productivity growth. And I've made nice comparisons about this when I went to the ECB to give a speech, and we were the envy of our colleagues in other central banks around the world, in Europe, in Canada, everywhere. They were asking, how are you managing to have those high levels of productivity that you're seeing in the US? And one of the drivers has been business formation, really strong business formation during this time period, 22, 23, and they continued until 2024. So that really helped. And of course, you have AI and some technical change that is happening, and we're not quite certain how much that has already contributed to productivity increases, but it may also be part of the story. And the third one is sectoral reallocation, and the fact that the matches in the labor market are just so much more effective now, with people being able to work remotely, right? So you live in Colorado and you work in New York, or you live in North Dakota and you can work in Texas, right? In many cases, that labor market just became bigger, and that allowed for a lot more better matching and much more efficient labor market. So those stories can explain how we achieved, right, to be on what economists call that is the part of the Phillips curve, reducing inflation without creating massive unemployment. So back to your question. So yes, it helped at the moment. Now, the influx of immigrants started to slow in the second half of last year, and it has continued to slow even more. I can tell you that so far, and I'm paying a lot of attention to this because I think it did help us on the way down. So far, we're not seeing very strong pressures on the labor market as a whole. I'm paying much more attention to sectors like agriculture, where 80% of the labor force is immigrant, or construction, where 40% of the construction labor force is an immigrant workforce, or services, even services, health have like about 20%, 1 in 5 workers are immigrant workers. So I'm paying attention to those sectors. So far, we have seen that wages have continued to stay down. So the question before, right? Wages are actually below 4% in many of those sectors, consistent with 2% inflation and productivity being pretty high. So far, so good. I'm not telling you that, right? If we start seeing much more of that phenomenon happening down the road, we may not start seeing it, but so far we haven't. And I have to say, our job at the federal, I always tell people, you know, we have a very clear mandate. It's maximum employment and stable prices. So we don't work on industrial policy. We don't work on even immigration policy. The only reason I look at some of these issues is to understand how it affects my mandate. So I'm going to have to, unfortunately, say I can't answer that question for you because it's a broader question to be considered by those considering industrial policy or, you know, the growth of manufacturing, and certainly there may be some changes, but it's been talked about, and we'll keep a close eye on it.
One question here.
And one here.
And one here.
Hi, my name's, excuse me, Evan Ramstead. I'm a journalist with the Star Tribune. Yesterday, there was an op-ed piece in the New York Times by an economist from Cornell who said that part of the reason for some of the political upheaval around the world, as in places like South Korea lately, of course here in the United States, is that countries are experiencing what he called economic stagnation, and he listed several reasons for that, including demographic change, you know. And so I wanted to ask you whether you think that economic growth is becoming harder to achieve.
We're
Yes.
taking the last question here, I understand.
So my name is Tim. I work for an agribusiness in the Twin Cities here for about 35, 40 years. And I asked this question to Art or to the other gentleman from the retiree from the Fed years ago. So I'm going to ask this again. It's a 25, 30-year-old question. We've seen from the executive branch of the government that there is some very ambitious, motivated policies that can be pursued. And it's possible that Congress can be aligned with some of these policies from time to time. So if we see a leadership team coming in who, instead of wanting to avoid inflation, wants to pursue inflation by, as quietly as possible, pushing the national debt out into the far deferreds as quietly as possible over a sustained period of time, and then electing to choose inflation to try to deflate the real value of the national debt. Is this a scenario that the Fed has ever discussed in your experience? And how might the Fed react if some triumvirate of the government tries to pursue such a policy in the future?
Third question, or this is it?
I guess
we're
this
going
is
with
it. We're running.
Okay, so
late.
on the stagnation question, let me just say that I was talking about how productivity growth is at 2.14 now when it was at 1.5 pre-pandemic for a long time. So I don't call that a stagnation, certainly, right? The economy is growing. It's growing at a healthy pace. Much of that is coming, as I said, we are the envy of the world. That was not happening necessarily all around the world, but here in the US, we had a lot of productivity growth that was really helping us. And I think we have some good explanations for that. Business formation, our entrepreneurship is like nothing you see anywhere else in the world. We have to be very proud of that and hopefully keep it that way. And we know that when new businesses come in, they become more productive. They create competition for existing businesses. That raises productivity of those businesses as well. It just becomes a virtuous circle. It's a good thing, and that is happening. AI, for sure, has been adopted much more broadly than I think most people know. There are about 16 surveys by now asking businesses about adoption of AI, and adoption is somewhere between 20 and 40% across the economy by most businesses, and it continues to grow. So obviously, we'll see if there are going to be proper applications in different sectors for AI to be helpful. But it's being used, and it seems like it may have mixed effects on unemployment, but it's not clear that it's going to displace everybody. It may create new jobs and new tasks. It may enhance the productivity of existing workers, and so it could be a good thing down the road. I think it's much more like a general purpose technology and something that can be used across the board. So I think there are good reasons to think that productivity will stay. I do think, right, if you now protect the economy so much that you don't let those new businesses come in, then you're creating a bit of a reversal on that end, right? So I think I will certainly be paying a lot of attention because I have been one of those productivity optimists up until now, and I think I'll be paying a lot of attention to see if those business dynamics start to change. I don't comment on fiscal policy, on what the executive does or what Congress does. So I will stay away from that. But I can tell you, obviously, and again, this is all coming back to our mandate. So what do we pay attention to? We pay attention to anything that can affect what we call R star, the neutral rate of interest, to figure out how tight or loose our monetary policies. And the debt is one of those factors that might affect R star. So certainly we look at all these factors, but we will not opine on what Congress or the executive are trying to do or what their aims at. I just don't get involved in political commentary. So I'm looking at the economy, how it affects my mandate and the mandate of the FOMC and what we do, and then we take it into account. We're certainly paying attention.
Okay, on that line, thank you very much, Governor,
Thank
for
you.
your comments.
Yeah, thank you so much. Gracias.
So
Gracias.
thank you to Governor Kugler and Dr. Nicolini for the presentation and engaging discussion. Thanks also to the faculty and staff, especially the staff, who assisted with the evening tonight. I encourage you to visit the Heller-Hurwicz Economics Institute website for more economic research and policy briefs, including links to episodes of our podcast, Office Hours. This conversation will be made available as a special episode of our Office Hours podcast, so watch for that. Now, please join us in the atrium for a reception and a poster session featuring research conducted by the 2024-2025 HHEI Undergraduate Research Assistant Program. Thank you to everyone for joining us tonight.
Thank
Thanks.
you.